I'd be comfortable with some weakness in labor markets if we start to see some job losses. But to be honest, we're far from that today.
We're going into this with an incredibly strong job market. This is not like other situations we've had historically.
We won't be able to get the strong labor market conditions we had in the last expansion unless we get this inflation down.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Bearing the burden, inflation concerns, recession risks, and central bank policies push global bonds to their first bear market in a generation. It's U.S. Jobs Day. The hotly anticipated data has the potential to tip the scales towards a third jumbo-sized Fed hike this month. And crunch time. EU leaders warn that Europe may not be able to avoid energy supply shortages this winter, even as flows look set to resume through the Nord Stream pipeline. It's Friday. You made it to the end of the week, and there is some positive risk on moves, but it is ever so slight after a pretty ugly week. U.S. equities able to end the session marginally higher yesterday. They are lower this morning, down about 0.1%. We've seen some of the biggest outflows, according to Bank of America, from global equities in some time. It's been a very difficult period following on from that Fed Jackson Hole meeting. At the same time, yen piercing through versus the dollar, that 140 level, that psychological level. At what point do we start talking Bank of Japan intervention? Perhaps we are a while off that, considering that they do not have the same inflationary problem that the rest of the world does. We're also looking at U.S. 10-year yields. Those are nice and flat this morning. They're hanging around 325. Front end of the curve still around its 2007 high. We are in a global bond bear market. I'll get to that stat in just a moment. Meanwhile, NYMEX crude up 2%. We had seen some declines. Of course, it's trading around 88, which this time last year we were much. Yesterday we're much higher than that, but we do have some talk around the Iran nuclear deal that the U.S. Says that the talks aren't constructive at this moment, so perhaps some of that getting priced out of the market at the moment. So yes, U.S. futures are lower, but we are seeing some gains in European stocks. Perhaps it has to do with the pot of session in the U.S. yesterday, or just some consolidation after a tough week. The outperformer this morning is the DAX, up more than 1%. You're looking at the FTSE 100 up about 0.5%, but most of these indexes higher. But again, for the entirety of the week, we are looking at the worst week for global equities since June. Now, let's get back to that bond story, because as I said, global bonds, they've slumped into their first bear market in a generation. That's as central banks ramp up an effort to tame inflation, even at the cost of a possible inflation. So there you go. There's the Bloomberg Ag. You can see down from that 2021 peak more than 20%. Well, let's get into markets now. We're joined by our very own Christine Aquino from our Bloomberg's market team, and Patrick Armstrong, CIO at Plurimi. Well, thank you both so much for joining today. Christine, let me kick it off with you and just sort of setting the backdrop here. We're down 20% on the bond market. I got to be honest, I kind of already thought we were there to some degree because it's just been such a bad year for bonds. This most recent leg lower, what's driven it?
Well, I think it is, Danny, the realization that we're back into September, you know, the sort of narrative of, oh, maybe inflation has peaked and equities can rally again and risk can be supported again over the summer. That's very quickly fading, especially after we heard from various central bankers at Jackson Hole. And I think really, whether it's the Fed, whether it's ECB, potentially even the BOE, it seems like 75 basis points is kind of the new number that's being tossed around as really what central bankers have to deliver. And therefore, the move in bonds has really kind of came back swinging after a bit of a benign summer, really, as this kind of realization that, oh, yes, they're going to have to do more. We're going to have to see yields much higher from here settles in.
Yeah, Patrick, so, I mean, we're back to the downtrend, right? We're back after that pause. To what degree is this a sustained trend, that it is a new secular bond bear market?
I do think the longer duration bonds have further to fall. I think the shorter duration bonds have all the Fed's moves priced in pretty much now. ECB's pricing in 75 basis, or markets pricing in 75 from the ECB now. So I think all the near-term stuff central banks are going to be doing is reflected in the front end. But inflation, I think, is going to be persistent. You've not really seen a change from governments. They're still running big deficits. You've seen monetary policy get to the point where it's neutral. Even today, it's still stimulative where the Fed is today.
Right.
So Powell alluded, he said, we may be at neutral, but they're not. 75 basis points gets them to what plausibly can be neutral. So we're getting to the point where we're stopping inflationary pressures rising, not curtailing them yet.
So if it is all priced into the front end of the curve, what does that mean for your cross-asset allocation? Because I have seen that used as an excuse. Okay, maybe it's okay to dip back into equities. You know, maybe some of these other currencies, not the strong dollar, might be attractive. Does it change anything for you?
I think dollar is going to continue to strengthen. That'll reflect that the Fed will continue to be more hawkish than other central banks. I think the ECB will want to get 75 basis points in, and then their window closes. I think Europe's in a recession right now. They'll be able to get 75 in, but after that, it's going to become more and more problematic for them to do. And if you look at interest rate futures, it's got the ECB hiking in 2023 while the Fed's cutting. No way that happens.
Yeah, I want to get into that dichotomy, but I mean, first, Christine, to Patrick's point, we are pricing in cuts for next year. I want to get both your take on this, whether it's going to be the market needs to price out Fed cuts next year and say we're going to keep going, or whether it's the ECB that's going to be cutting once we eventually get a recession. What does it seem that folks are saying is the most mispriced at this moment, Christine?
Well, I feel like it's the latter, Danny. I think it really is just the market's kind of, you know, I think we have to remember the ECB is a little bit behind, or a lot of it behind, from the Fed in terms of its tightening cycle, and that's why markets haven't really kind of digested the possibility of cuts. But to Patrick's point, you know, Europe is in a recession. We have an energy crisis looming. It's going to be a very challenged environment. I think it really is just markets kind of haven't gotten to that point beyond the rate hikes to start thinking about cuts. But it's only inevitable, I think, down the road.
I see that, but you know, Paul, I also got to say, if I can challenge you a bit, Christine, I don't know, Paul, whether you, Patrick, you'd agree with me or not, but Patrick, isn't there some degree to which the market pricing in cuts next year for the Fed just doesn't make sense?
It's too cute, I think. While the Fed's hiking to pricing in a cut, it would mean the market knows exactly what the outcome of the Fed's policy is going to be, while the Fed doesn't. And I think that's probably a bit arrogant for markets to say. I think the Fed's always made the mistake where they've hiked too far and then quickly had to cut because they provoked a recession.
Yeah.
The Fed policy members now know about that, and they're going to be adjusting their policy accordingly.
Christine?
Well, I think this is why we have the don't fight the Fed adage, right? But this is kind of the history of markets versus central banks, right? Kind of markets really over-egging one direction or another in terms of policy, and then they actually see the central bank response as a bit more measured. And it has to be a bit more measured because it's not just kind of one thing that they're considering. It's the impact of these policy actions on markets and the broader economy, which is really what matters to them. And then markets have to adjust. And so I think this is really just kind of this push and pull process. What I will have to say is that markets have kind of, I think, successfully kind of pushed the Fed and central banks into thinking about this policy shift. Because, you know, again, we saw markets kind of pricing for this tightening shift as early as around this time last year, when, you know, it wasn't quite a certainty that we were going to see this big shift in policy for the Fed and really a lot of central banks. So there is something to be said about kind of markets thinking forward in that. But of course, the impact of policy, another discussion altogether.
Okay, Christine, your time in the hot seat is up. We'll let you go from here. Christine Aquino from our markets team. Patrick, you're sticking around. Patrick Armstrong, CIO at Plurimi Wealth. Now, coming up, Britain will have a new prime minister on Monday, and whoever enters number 10 will have a very full agenda. More on the leadership race next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, the UK will have a new prime minister on Monday, and bookmakers and opinion polls point to a victory for Foreign Secretary Liz Truss, beating her rival former Chancellor Rishi Sunak. Now, whoever enters number 10, though, will have a very full agenda. Joining us now is Bloomberg's Lizzie Burden. Patrick Armstrong, CIO at Plurimi Wealth, is still with us. So, Lizzie, let's start with the economic picture, the backdrop that the new prime minister will face. What does the set of challenges look like?
Very full in-trade praise. So you've got double-digit inflation in the UK. Goldman Sachs has said that it could go above 22%. It's driven by the energy crisis, of course. You've got more than households facing potential fuel poverty. The Bank of England responding with rate rises back to back, could go up to 4.25%. You've got the labour shortages leading to bargaining power for workers, demanding higher wages, strike action across the country. Put it all together, and the Bank of England sees recession risks, growth, negative growth, slowdown, stagnation for 2 years.
And I feel like this is part of the thing when it comes, I mean, I guess this is a Europe issue as well, that the BOE can only do so much when it comes to the energy crisis, that to some degree we're looking to fiscal policy to see what they will do. I mean, from what you've heard, Patrick, in terms of fiscal policy, does it change at all the calculus for what sort of political risk should be priced into UK assets right now?
The fiscal response so far has been a bit of populism, basically promising that I'll do quick tax cuts, or if it's Liz Truss promising she's going to solve something with Northern Ireland and maybe triggering Article 16, things like that. So I think she's going to try for a big near-term win.
Yeah.
I don't know if it'll be a long-term strategic plan, but she'll want to get that quick win under her belt, assuming it is Liz Truss on Monday.
Yeah, I mean, to that point, Lizzie, what is sort of like the economic worldview of Liz Truss?
Well, she's expressed her preference for tax cuts over handouts, as she calls them, the whole way through the campaign. But it does look like that campaign economics could change into a bit more government realistic economics when she joins. The whole point of the emphasis on tax cuts, though, is that she says it would stimulate economic growth. The IMF had said that Rishi Sunak's tax rises were part of the recession risk in the UK. But she also, the big other thing in Trustonomics is that she wants to take on what she calls the blob, the Treasury and the BOE, the economic orthodoxy there. And part of that is changing the BOE's mandate, or at least reviewing it. And so that's been worrying for market watchers.
Are you worried about that, a change to the BOE's mandate?
I think it's going to happen over the next decade, that we get more comfortable with inflation that's persistently above 2, and 2's not the targets, and it drifts to maybe 4 or around 2. Things like that have already happened, that it used to be below 2 and then to an average of 2. And populism's the winning model in governments. When you're spending more than you're taking in revenues, it's going to create inflationary pressures. And I think populism isn't about to change, well, in the next few years.
I was going to say, just looking at sort of your positioning, it's not one necessarily, Patrick, that elicits, optimism about the UK economy. I see that you're short some of these property companies. Talk me through your thinking.
Well, you've got rising interest rates, growing credit spreads, and their funding costs are really going up. You've got companies reassessing models where there were 3 days in the office, 2 days from home, hot desking, you need less office space. All of those things mean you're not going to get rental increases, you're facing higher yields, lower capital values. So I think shorting property companies in the UK makes good sense.
Yeah, and Lizzie, I feel like we have been talking a lot about this week about a UK housing crisis, issues in the property market. How much do we know about what Liz Truss, her team, what people have or haven't said about what they plan to do to tackle it?
Well, at this stage, where the two candidates are appealing to the grassroots Tories, the Tory membership, the ballot closes at 5 p.m. tonight, they're having to preach to an audience that doesn't necessarily want more homes in their back gardens. So Rishi Sunak said that he won't build on the green field. Liz Truss has not committed to this 300,000 a year new homes target that the government currently has. And so if they don't come out with more policies to build more homes, when whoever takes power does, then that shortage could continue to boost house prices. We had more data from Nationwide yesterday. We're not really seeing the major housing market slowdown that analysts, policymakers at the BOE have been warning about for a long time. But there is this slowdown in buyer demand, which usually portends a slowdown in prices.
Right, and Patrick, I mean, we were talking before sort of this dynamic, this mispricing between the Fed and the ECB. Talk to me about, I know in the break we were talking about sterling euro dynamics, the dynamic and what the market consequences of that will be between the ECB and the BOE and the set of challenges they face.
They're both facing incredible challenges.
Yeah.
Stagflation is the toughest environment for central banks because you've got higher prices, slowing growth. Whatever you do is going to magnify one and hurt the other one. And they're in no-win situations. They're not going to get inflation down without provoking recessions. We're already in recession in both those regions, but they've got to hike because inflation's still growing in Europe, still growing in the United Kingdom because of the weak currencies, where I think it's probably plateaued in the United States.
Okay. Patrick, thank you so much for joining us this morning. That's Patrick Armstrong, CIO at Plurini Wealth, and also our very own Lizzie Burden. And of course, stay tuned. Monday, we're going to have the conclusion of Britain's leadership race right here, coverage of that on Bloomberg TV and radio. We're going to bring you a special starting at noon London time. Let's now get to the Bloomberg First Word News. With that is Leanne Gerrans. Leanne.
Good morning, Danny. President Joe Biden has accused Donald Trump and so-called MAGA Republicans of assaulting the foundations of U.S. democracy. In a primetime TV address, he urged Americans to reject any candidate backed by his predecessor in the November midterm elections, labeling them extremists.
MAGA Republicans represent an extremism that threatens the very foundations of our republic.
Now, the company that runs the Zaporizhzhia nuclear power plant in Ukraine says a team of UN inspectors will remain there until Saturday. It's the first time in the IAEA 65-year history that monitors have crossed an active battlefront in order to carry out an inspection. Now, supermarket shelves were emptied and anxious motorists filled the roads trying to get home in the hours before Chengdu's 21 million residents were put into a strict lockdown. It's the fourth Chinese megacity to be locked down so far this year as Beijing pursues its COVID-0 policy. Local officials have given no information on when that lockdown will actually lift. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thanks so much. Coming up on the program, Credit Suisse is reported to be weighing 4,000 job cuts as it works on its latest overhaul plan. We'll get you that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. According to Germany's Handelsblatt newspaper, Credit Suisse is weighing 4,000 cuts. This as the lender overhauls its business after a series of financial and reputational scandals. For more on this, we're joined by Bloomberg's European finance reporter, Nick Comfort. So, Nick, a lot of numbers floating around out there about what potential job cuts we might see. But if I was an employee at Credit Suisse, what should I be expecting?
Yeah, I think numbers at this stage are probably speculative, as the bank would put it. But I mean, or as a reporter, I'd say they're not final numbers, so we shouldn't get too wedded to the numbers. We at Bloomberg reported that job cuts could be in the thousands. So for people at Credit Suisse, I think it's probably a question of thinking, what division do I work in? Is this an area which the bank still wants to remain in? Is this an area also where the bank will be focusing its cost cuts? That's probably a key question. Sitting in Switzerland, I'd say the employees are probably in the business side of things are probably safer. In the wealth management divisions are probably safer. But the investment bank, that's definitely an area where, depending on the division, the bank may want to be exiting the business which these people are working in.
And of course, you know, what we have heard from Credit Suisse, basically saying, hey, wait for our next results, then we'll give a strategic update. What should we be expecting?
Well, they give us a pretty good hint with their second quarter earnings. They said they want to be they focus their investment banking on advisory and capital light businesses. So basically things that complement their wealth management franchise. They want to be. They've highlighted even that they would be seeking partners or seeking third-party capital, as they put it, for their securitized products business, which has fewer links with the rest of the bank. So that business, I mean, certainly they will be looking at trying to move out of it in some way. Analysts say that really to get the full benefit, you have to really sell the entire division. But other businesses as well. I mean, look at leveraged finance and high yield bond issuance. Potentially also equities would be an area where they could be shrinking further, either because they want to reduce that capital intensity or also just to reduce the costs which these businesses are swallowing up. The investment bank has, in some businesses, delivered great performance in individual quarters, but if you look at the losses over the years, every couple of years they've had to take, it's a tough business to really argue to be in for the long term.
Well, in about a minute here, Nick, but just sort of overall, how has performance been for the businesses at Credit Suisse?
Equities trading and debt trading have had a tough time this year. I mean, I think it's also a question of just maybe some clients losing confidence in the bank. The advisory side had a great second quarter, so you can really, that's easy to argue for keeping it. But it's really a question of sort of winning back the trust of clients in trading. It has been a tougher job for them.
Okay, Nick, thank you very much. It's our European finance reporter, Nick Comfort, giving us the latest on Credit Suisse. Shares are actually higher this morning, a 4% drop yesterday, today, making up some of that lost ground, up 2%. Now, coming up, global food prices dropped for a fifth month in August. We're going to get into the drivers and the outlook next. This is Bloomberg. Bearing the burden, inflation concerns, recession risks, and central bank policies push global bonds to their first bear market in a generation. It's U.S. Jobs Day. The hotly anticipated data has the potential to tip the scales towards a third jumbo-sized Fed hike this month. Crunch time, EU leaders warn Europe may not be able to avoid energy supply shortages this winter, even as flows look set to resume through the Nord Stream pipeline. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, global food prices, they fell for a fifth month in August. That's after demand for some products weakened and there was a seasonal uptick in supplies. Falling prices may offer some relief to consumers as they grapple with a deepening cost of living crisis. Let's bring in Alvin Tai from Bloomberg Intelligence on this. So, Alvin, are we at a point yet where we can decisively say that global food prices have peaked?
Hi, Danny. Yes, I believe so. If you look at the Bloomberg Agriculture Spot Index, it has given up about 100 points of the gains that it made in the last 2 years. I think there are actually more to be given up once the market is sure that the upcoming La Nina will not have any negative impact on prices. Bear in mind that prices are still relatively elevated compared to where they were pre-La Nina, so there are actually, more prices to be given up in the months ahead.
Right. Alvin, thank you for laying out the scene for us. Alvin Tyne there, Bloomberg Intelligence, our intelligence analyst there on agriculture. Now we're joined by Erin Collier, economist in the Trade and Markets Division of the UN's Food and Agriculture Organization, which of course just put out this report this morning. So Erin, our analyst Alvin there saying that he does believe that it looks like we've reached a peak in prices. So perhaps they've peaked, but I do wonder how much of a comfort will that be for nations still having to shell out for food that's more expensive than average?
Yeah, thanks so much. Right, as you mentioned, food prices reached a record level actually in March, which was a very concerning level for food prices in the world. They have been coming down in recent months. We saw them ease again in August, which is the good news. But the bad news, as you mentioned, is that food prices are still really, really high. They're still even marginally above previous records set before this year, which is in 2011. So seeing food prices still really high, and a point of concern is the fact that cereals, which have been a main driver of these price increases, remain very high. They actually decreased the least this month. And as you know, in cereals, wheat is a very important staple food for a lot of countries in the world. So right now with prices so high, especially with the US dollar so strong, that will make importing those supplies really expensive for a lot of countries.
Yeah, that's exactly where I wanted to go next, Erin, in terms of dollar impact for these nations that are facing weaker currency. In terms of the geological divide, where does it seem in terms of who's facing the most pressure from that, the need to pay up more, again, because of the divergences among global currencies?
Well, obviously, first and foremost, it's countries that rely on imports for their food needs. So, import-dependent countries, also low-income countries, especially those that are facing economic challenges in the wake of the pandemic. Also, concern has been countries, especially in Middle East and Northern Africa, that are typically big importers of wheat, especially from Ukraine and Russia. So now that the supplies have been disrupted from that region, from the Black Sea region, for nearly 6 months now, that obviously, has created higher costs for those countries to import the wheat that they need.
Erin, what will it take to see normalization? In other words, how far away are we from a level that's more comfortable?
Well, like I mentioned, prices are still above the 2011 record, so we still have a ways for prices to come down. And I think it's really important that the export flows out of Ukraine continue. We saw prices drop in response to the opening of ports in Ukraine pretty quickly in July. So that is it's very clear that that's having a big impact in helping to bring prices down by boosting supplies. So for that to continue, I think, is a really essential part of that happening.
How worried are you? This is a narrative that picked up speed after Russia first invaded Ukraine. This idea that we would see more hoarding of commodities, of assets, be it agriculture, be it energy. Does that seem like a threat that could be lived out, or are we less concerned about that than perhaps we were at the beginning of the war?
Yeah, at the beginning of the war, there were certainly kind of a wave of a lot of policies being implemented to kind of protect domestic supplies, which, when you see that happening in major exporting countries, especially restricting exports, that will push up prices, that puts pressure on markets, which, is something we want to try to avoid. So it does seem that has started to improve that situation. Again, like I said, even the fact that ports opened, Ukraine's starting to see markets open a little bit more, and that's something that we need to see continue.
When it comes to the impact of droughts we've seen and extreme climate from, not just droughts, but floods in other regions as well, if this is the new normal, Erin, what does it mean in preparing for the global food trade? What does it mean for global agriculture going forward? Are there structural changes that need to be made if this is the new reality of climate?
Yeah, this year we're forecasting to see a pretty big fall in maize production, for example, at the global level, which is making maize markets really tight, and that puts upward pressure on maize markets, which also in turn puts pressure on wheat markets, which is, as I mentioned, a very important food staple. So that fall in production really has a big impact. It's something that countries need to be very cognizant of, and as weather patterns get more and more extreme, this year we've seen really hot and dry conditions in the European Union really cut into their maize production. We've seen hot conditions in India cutting into their wheat production, now flooding in Pakistan, maybe increasing the food demand that they have there. So, looking at production and putting in place support for producers to try to ward against these really extreme weather patterns, as they get worse and worse, is going to be really important. And again, mostly support to producers for them to be able to weather the costs of production that comes with. This year, we're already seeing record high, especially now with record high, energy prices and fertilizer prices being a very big concern, especially in the European Union for fertilizer production. As we see inputs become more expensive and farmers unable to purchase those inputs, that is going to be something that governments really need to help support the producers with.
Okay, Erin, I'm afraid we're going to have to leave it there. Thanks so much for joining us, though. Erin Collier, there, economist in the Trade and Markets Division of the UN's Food and Agriculture Organization. Let's get to your Bloomberg Business Flash. With that, it's is Leanne Gerrans. Good morning, Leanne.
Hi, Danny. The arrest of Glenpoint Capital co-founder Neil Phillips for alleged foreign exchange market manipulation is threatening to ripple across the hedge fund industry. Another firm has now suspended staff who previously worked with him. Phillips, who was associated with some of the biggest names in the hedge funds world, was arrested in Spain at the request of the United States. Now, Shell is reported to have shortlisted candidates to succeed Ben van Beurden, who is preparing to step down in 2023. According to Reuters, a number of internal picks are being considered. Van Beurden will leave after almost a decade as a CEO. Credit Suisse is reported to be weighing 4,000 job losses as it overhauls its business after a series of financial and reputational scandals. German newspaper Handelsblatt says the figure does not include cuts in investment banking. Executives are currently meeting in Singapore to discuss the company's strategy. And Lululemon shares have jumped in late U.S. trading after it raised its full-year outlook to more than $7.9 billion, beating analyst estimates. It is the latest sign that demand among high-income shoppers in the U.S. remains strong, even as inflation hurts purchasing power more widely. The company is aiming to double sales by 2026. That's by targeting men and opening more stores overseas. And that's your Bloomberg Business Flash. I know we like a bit of athletic leisure wear, Danny Berger.
Certainly cannot get away with wearing it during our job, but, you know, maybe on days off, Leanne.
Well, we're sitting on the sofa, Danny, yes.
Oh, I was going to say the gym, but hey, the sofa works too.
Big camp, yeah, we'll put it that way.
Leanne, thank you so much. Leanne Gerrans there. All right, coming up on the program, power problems. The EU sees its limits to its interventions in the European power markets. Well, that story for you next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. An emergency intervention in European power markets may lower prices, but it won't protect the region's economy from spillover effects of a historic energy crunch. A policy note seen by Bloomberg says that while the intervention tools can help mitigate the effect of the crisis, they will not bring energy prices back to pre-crisis levels or remove the significant effects of the crisis on the European economy as a whole. For more, let's bring in Anna Sheryevskaya, our European natural gas reporter. So, and of course, everyone is waiting for Nord Stream over the weekend. Of course, it indicates that a restart of flow from Saturday night will occur. Does this alleviate the worst case scenario, or are there still massive supply concerns left for winter?
Indeed, that helps alleviate concerns, especially as there have been risks that in the market that this pipeline would not restart as planned after 3-day maintenance. At the moment, we see the shipment orders indicate the pipeline will restart, but the restart will be at the same limited 20% capacity because only one turbine is operating out of 6 major turbines and 2 small. The others are out of service, and it's not clear when they will restart. What's more, Gazprom has said that this sole operating turbine will have to be serviced again after every 1,000 hours. That's in 42 days. So potentially we're looking at another shutdown for in the mid of October when the heating demand starts increasing, and that could again raise questions of how long maintenance lasts, when Gazprom will restart, at what levels.
I mean, Anna, that just feels like continued opportunity for fears for volatility. If we have more of these potential, shutdowns of the pipeline coming, I mean, how much fear is there in that, or is there any comfort right now from the fact that they have, although it depressed volumes, the flow does continue to reopen after maintenance?
Yes, indeed, the prices have decreased today, so we're seeing this already factored in. But the same prices remain several times higher than normal levels for this time of year, and we're not even in the winter season yet. What's actually also helping get some relief to the market is that storage levels are sufficient. In the European Union is ahead of its target for storage refill by 2 months. So there is some comfort knowing that even if Russia stops gas and we have sufficient stocks, we still have LNG coming to Europe. And of course, there should be demand reduction measures to guarantee that the winter supply will be unaffected.
Well, that being said, what are the steps that the European Commission is proposing to help alleviate some of the worst of this energy crisis?
Indeed, now attention is on the power market. What the EU wants to do to just rein in this unprecedented rally in the power market prices as well. And the short-term measures include reduction in power demand, including for market incentives, and price caps on non-gas power generation, such as nuclear, coal, and renewables, and limiting revenue for power generators, basically a windfall tax to ensure enough support and lowering bills. All these, as you mentioned earlier, as short-term measures, and the longer term, the European Commission is still debating on how to decouple gas and power prices. And yes, so at the moment, we are only talking about a kind of short-term fix.
Can you walk us through what that long-term fix, that decoupling, would actually look like, how it would function, and the potential effectiveness of it?
Indeed, it's like the details are still to be ironed out. We haven't heard much from the European Commission exactly how that will work. I think we'll have to wait till the meeting and the proposals of that measure. Indeed, power price, it's not all power generated from gas in Europe anymore. We have renewables, so I guess that calls to factor that in and just to conduct a power market reform, and see how that materializes as we approach the meeting.
Okay, Anna, thank you very much for joining us, giving us the latest on the European energy crisis. That's Anna Shiryaevskaya, our European natural gas reporter. Coming up, U.S. chip stocks tumble after Washington imposes limits on exports to China. We'll have more of that and the market impact next. This is Bloomberg.
Donald Trump and the MAGA Republicans represent an extremism that threatens the very foundations of our republic. MAGA Republicans have made their choice. They embrace anger. They thrive on chaos. They live not in the light of truth, but in the shadow of lies. More and more talk about violence as an acceptable political tool in this country. It's not. It can never be an acceptable tool. So I want to say this plain and simple. There is no place for political violence in America, period. While the threat to American democracy is real, I want to say as clearly as we can, we are not powerless in the face of these threats. We are not bystanders in this ongoing attack on democracy.
U.S. President Joe Biden there during a primetime address in Philly. Of course, important context, the U.S. heading into the midterm elections. Biden there clearly trying to stoke some concern, stoke some outrage, perhaps, as he hits the campaign trail for those running in the midterms. All right, now let's get to the Bloomberg First Word News. With that is Leanne Gerrans. Leanne.
Hi, Danny. Supermarket shelves were emptied and anxious motorists filled the roads trying to get home in the hours before Chengdu's 21 million residents were put into a strict lockdown. It's the fourth Chinese megacity to be locked down so far this year as Beijing pursues its COVID-0 policy. Local officials have given no information on when that lockdown will lift. Now, the company that runs the Zaporizhzhia nuclear power plant in Ukraine says a team of UN inspectors will remain there until Saturday. It's the first time the IAEA's 65-year history that monitors have crossed an active battle front in order to carry out an inspection.
I'm glad you pointed out that the inspectors are there. We're glad to see that. We hope that they're given unfettered access, and we look forward to their report about the safety and the operational efficiency of that nuclear power plant, because, again, the danger could be so much bigger, not just to the people of Ukraine, but even to the region.
Starbucks has named Reckitt Benckise's executive Laxman Narasimhan as its next CEO. He'll join the coffee giant at the start of next month, taking over fully next April. The consumer industry veteran is set to inherit issues including a growing union push and struggling sales over in China. Employees in the UK stepped up recruitment last week in preparation for a rush at Christmas. The Recruitment and Employment Confederation says 2.08 million new jobs were advertised, the highest figure for 2022 and the second highest on record. The figures suggest labour shortages will continue to be a problem for business. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much. The latest U.S. effort to restrict chip exports to China from NVIDIA and AMD has sparked concerns that escalating government actions could cut off some of the semiconductor industry's biggest companies from the largest market for their products. Joining us now is Bloomberg's Charlotte Yang on this. So, Charlotte, we had this pretty ugly global sell-off yesterday when it came to the semiconductors. Walk us how we got here, how we got to this turning sentiment on them.
Yeah, so global investors have been on a selling spree of semiconductor shares since the report that U.S. is escalating efforts to curb some chip exports to China. And the sobering warning from NVIDIA that about $400 million could be hurt in sales, that's just this quarter alone, if it doesn't get permission from the U.S. government to export those chips into China. This is dragging market sentiment down a lot. And considering that the Philadelphia Semiconductor Index is already down over 30% this year because the sector faces high inflation, excess inventory, as well as this waning demand from personal computers. This is a listing of an escalating technology boycott from U.S. on China. Is a listing that investors want to see.
So, we do have pre-market. Some of the U.S. chip makers are up slightly, but of course that could just be sort of a factor of the deep sell-off they saw yesterday. But one thing we did see, Charlotte, is in the Chinese session, some of those Chinese chip makers were able to surge, were able to defy the market gloom. Why is there such a different story there?
Yeah, so the Chinese semiconductor shares in today's trading are telling a very different story. We're actually seeing some of those shares throwing a rally party, even though it could be short-lived, as some of those speculative bets come from investors. So the main logic is because some investors see that as U.S. intensifies efforts to curb exports to China, then these homegrown producers will be able to get more market share, even though their technology at the moment is still behind. And we've seen this kind of trading strategy in the past as well. And the one notable example today is this AI chip maker, Chemicron, which surged as much as 20%, has already entered overbought territory.
Okay, Charlotte, thank you very much. That's Bloomberg's Charlotte Yang there. Some breaking lines now on Credit Suisse. They have been hit by some key resignations in their private bank, specifically in Hong Kong. Bloomberg has learned of 2 resignations, managing director on the China team who resigned this week and a team leader on the Hong Kong team. Now, Credit Suisse, when asked, said that they don't comment on these moves, but referred to a statement saying that in spite of all these rumors flying around that Credit Suisse is pulling back or pulling out of China, China is still a long-term play for us. Of course, this also comes in the context of a revamp from Credit Suisse as they face some of the outflows when it comes to the scandals that have triggered billions of dollars in losses. All right, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kriti Gupta, and Tom McKenzie will take you through that. This is Bloomberg.
I'd be comfortable with some weakness in labor markets if we start to see some job losses. But to be honest, we're far from that today.
We're going into this with an incredibly strong job market. This is not like other situations we've had historically.
We won't be able to get the strong labor market conditions we had in the last expansion unless we get this inflation down.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today.
jobs day in the US. Today's numbers could determine whether the Fed decides to go for another jumbo-sized interest rate hike this month. President Biden banks on Democrats' outrage. He blasts Donald Trump and his supporters in a speech aimed at rallying voters ahead of November's congressional elections. And Europe's natural gas market gets some relief. Prices fall as Russia prepares to resume gas supplies through its key pipeline. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Matt Miller and Kriti Gupta in New York. Anna Edwards and Kailey Leinz are off today. Kriti, whether you're in London, in New York, it really is all about the jobs number today.
It is all about the jobs number, and I think it's the sentiment that was shared in the Asia overnight session as well, where you did start to see a little bit of a risk-off tone. The hangover there in that region, well, it really continues. The MSCI Asia Pacific Index down about 0.5%. Remember, that selling conviction that we've seen the previous days did not carry on last night, perhaps abating just a little bit. That wait and see, still in wait and see mode. How much of catch-up does it play come Monday's session? That being said, we are seeing a lot of pain when it comes to tech. The Hang Seng Index, for example, a lot of tech concentration in that Asian index specifically, that down about 0.7%, underperforming the broader market. But of course, part of that tech story, a huge part of that tech story, is the chip saga. The idea of how much kind of deglobalization is really playing out in the chip sector, whether it comes to United States regulation or simply a lack of production in the Asia Pacific region. And that is actively going to affect the Kospi index, the South Korean index, where of course we know Samsung is a major heavyweight, down about 0.3%. And true to form, I have to stick to the currency story. Dollar yen once again hitting some new weakness here. We are at a now 140 handle on that currency pair. Matt, it just gets worse and worse.
Yeah, absolutely, and it still remains interesting nonetheless. Take a look at what we're prepared for here in the U.S. This is what happens when you have a big data print like a jobs number or a Fed decision. Equity traders sit on their hands. A lot of times they'll turn the algorithms off as well because they're worried that the machines won't be able to read the data as well as humans will. So far. Right now, so S&P futures unchanged. U.S. 10-year yield also very little change, but at a relatively high level. And it seems like the debate about the end of the bond bull market has come to a conclusion, especially since the global ag has now indeed fallen 20% from its peak at the end of last year. So right now we're looking at 325.56, and most strategists don't think we're ever going to go back to the lows that we saw, or not in the near future, during the pandemic. The Bloomberg Dollar Index hit an all-time intraday high yesterday. Remember, I told you Valerie Titel, our London charts producer, pointed out it was 1304.55, I believe, July 14th. And yesterday we soared above that. Came back down a little, but we're still near there at 1302.59. And then Bitcoin also really not doing a heck of a lot. So there's so much going on, Tom, in markets, but risk assets really aren't moving that much as we wait for this jobs data to come out at 8:30 a.m. New York time.
There's a little bit more traction here in Europe. Part of that you would assume is a bit of catch-up in terms of the modest gains that we saw stateside yesterday. And of course, you've had, the context is 5 straight days of losses in Europe. Turning around that sentiment today, a big part of that will be what's happening in gas. And I'll break that down for you shortly. But broadly, you're seeing gains of about 0.8% here in the UK. The CAC current is up 0.7. Over in Germany, gains of more than 1.4%. And it's autos that is powering the gains over in Germany. Let's switch it over then and see how things are playing out across asset. I talked about the gas picture, so the news that that data around the pipeline suggests that flows will come back on Saturday, even as our team points out that they are expecting the Russians to have regular treks on the pipeline, which could lead to further volatility in gas prices. You have seen that drop almost 9% on Dutch gas today. That is supporting the euro, and it's also playing into what's happening across these equity markets. Gains then across the benchmark of 0.8%. Euro dollar still below parity, but upside of 0.3, and part of that will be gas. A number of FX strategists saying it's more about the energy picture than rates when it comes to the single currency and its direction going forward. Shell, this is one corporate story that I just want to pull out for you. Reuters reporting that the CEO, Ben Van Beurden, will be stepping down in 2023. Seems they've got some internal candidates being lined up. Gains of 1.7%. He's been in charge for about a decade, and it has been consequential in the transition for that company. Kriti.
Certainly something we are going to watch. Now let's take a look at what is ahead today. Tonight at 5 p.m. UK time, the UK Conservative leadership ballot closes. The new Prime Minister will be announced on Monday. And the European House Ambrosetti Forum kicks off in Cernobbio, Italy. Speakers include Commissioners Valdis Dombrovskis and Paolo Gentiloni. And then the main event at 8:30 a.m. New York time, we'll get the U.S. unemployment report, well, U.S. employment report, I should say, for the month of August. All that payrolls number, of course, in the spotlight all week long. Joining us now to look ahead to that very jobs report is Michael McKee, Bloomberg Chief Economics and Policy Correspondent. Okay, what's the number? Tell us. You're not too far off in talking about unemployment. I'll explain. But the number you want to watch when we begin is the headline number for jobs created. The forecast is for 298,000. But remember, it was 250,000 for last month, and we got 528,000. So if we do get a really strong number, then that does point the Fed in the direction of 75 basis points, more work to do. 3.5% unemployment, not expected to change. And we are expecting a slight decline in the month-over-month average for wages, but not for the headline year over year. So that leads us to this question. What is it in there besides the total number that will affect the Fed? And that's going to be wages. Are wages still rising as job numbers, as the job openings numbers rise and unemployment falls? Wages have been going up. They've flattened out a little bit. Do they go higher? That's an inflation problem, and the Fed has to act. Do they stay flat or start going down? Then maybe that cautions to 50 basis points.
Yeah, and I noticed the Bloomberg Whisper number. Yesterday it was 270. Today it's 287. So getting closer to the consensus, but still under. And I'm just wondering, is that wishful thinking? Because these are obviously market participants, and they would like to see maybe the job pain coming sooner so the Fed feels the pressure.
That may be the case, and there is an argument at the Fed that you want to do it sooner, get the rate up as high as you can or as high as you think you need to right away to get ahead of inflation. But there are others who say, well, we haven't seen the impact of all the Fed rate hikes so far, and maybe it's going to be really harsh, so we should do it more slowly.
Because monetary policy lags, right?
That works for the lag. So that may be one reason for them only going 50 if the data is ambiguous. But we have the CPI report on the 13th rather, and that's going to be the real defining number.
All right. Very interesting stuff.
Bloomberg's Mike McKee previewing those job numbers for us. And of course, we know that officials in Washington, D.C. Are going to be looking ahead to those numbers as well. President Joe Biden, meanwhile, has accused Donald Trump and so-called MAGA Republicans of assaulting the foundations of U.S. democracy. In a primetime TV address, Biden urged Americans to reject any candidate backed by his predecessor in the November midterms.
MAGA Republicans have made their choice. They embrace anger. They thrive on chaos. They live not in the light of truth, but in the shadow of lies. But together we can choose a different path. We can choose a better path.
Okay, Jack Fitzpatrick, Bloomberg government reporter, joins us now. Jack, what really kind of stood out to you then from this speech by Biden? He got pushback from Republicans, but it's something that the Democrats, at least many within the Democratic Congress, have been pushing for him to do, take a harder line on this issue.
Yeah, I mean, if anything stood out from this speech, I think there are two pretty obvious takeaways. One, he mentioned Donald Trump by name very early on. For a while, President Biden tried to avoid mentioning Trump specifically, kind of moving past it, which makes sense because Trump is not on the ballot himself. But clearly it's gotten to the point with the legal issues around Trump and just the centrality of Trump in Republican primaries in these midterms that the president felt the need to go directly at Donald Trump and mention him by name. And really, I think the other point of emphasis was, we've heard this message generally from President Biden before, but the decision to hold a primetime address with the symbolism of holding this at the place of the signing of the Constitution. It's clearly a major point of emphasis and a major, I guess, line of attack heading into the midterms. He's been on the defense talking about inflation, the possibility of a recession, trying to reframe the campaign narrative around democracy and good government and the issues that have popped up in Republican primaries with support for Trump being so central to them. That's something that President Biden wants to be a bigger focus in the midterms in the next couple of months.
In terms of, what's happening on the geopolitical stage, it does look like the policies of the West are pushing Iran closer to Russia and China. And now, obviously, that puts the possibility of a nuclear deal, which was already a very small possibility, really in question, doesn't it?
Well, yeah, the last news on this was bad news. The U.S. put out a statement from the State Department saying that the most recent response from Iran was not constructive. They haven't said specifically what the latest issue is and what their objection is, and the president was going to be briefed on this after coming back to Washington after that speech, but they said that the latest news is not good news. That's in the context, though, of people talking about a deal in the relatively near future. French President Emmanuel Macron said he was hoping for this to get wrapped up and have some sort of agreement in the next few days. And before this response by the U.S., they'd said that there had been some constructive dialogue. So I don't think it's been entirely bad news, but it's not something where they're quite at the finish line just yet.
Okay, Jack Fitzpatrick out of Washington of Bloomberg Government, of course, on the complexities around this Iran deal, at least the discussions on that deal. Now to the UK. Britain will have a new Prime Minister on Monday. Bookmakers and opinion polls point to a victory for Foreign Secretary Liz Truss, beating her rival, former Chancellor Rishi Sunak. Joining us now is Bloomberg's Lizzie Burden, on set, of course, here in London. Lizzie, give us a sense then of the economic challenges, and they are acute for the next PM.
They are. They're bigger than what Theresa May or David Cameron faced. You have to go all the way back to the early 1970s, to the oil shock and the miners' strike for a historical comparison to this. We've got double-digit inflation. It's only set to climb. The BOE sees 2 years of negative or zero growth. So what do we know about Trustonomics if she wins? Well, she says she prefers tax cuts to handouts, as she calls them, although she's rode back a bit on that more recently. She says tax cuts will help to stimulate economic growth, and to do that she's probably going to need to do more borrowing, so she'll change the Treasury's fiscal rules, which is part of her taking on the blob, which is her word for the economic orthodoxy at the BOE and the Treasury. Of course, she blames the BOE for the inflation crisis. She wants to review their mandate, but all of this is worrying for markets. We had former Deputy BOE Governor Charlie Bean warning about a crisis in sterling and gilts, and if you look at the pound since Boris Johnson resigned, just for context, it's performed worse than 132 of 150 major currencies already.
And certainly on parity watch as well. We'll also go from the UK to continental Europe. Is 75 basis points from the ECB now a done deal?
Well, lots of economists have come and changed their call from 50 basis points to 75 basis points off the back of that new record euro area CPI print, 9.1% in August, but also because of all the hawkish commentary out of the ECB and the Fed. Let's not forget Jackson Hole, Jay Powell's commentary makes the ECB look a little behind the curve, some on the Governing Council may be thinking. And so lots of economists have changed their call. Markets are fully pricing it in, but what economists say is it is not a done deal, because we had that statement from Philip Lane talking about the need for a more steady pace of hikes, and the worry is, what do higher borrowing costs do to a weaker economy like Italy?
Yeah, I think the Philip Lane, I guess dissent isn't probably the right way to call it, but advice was really interesting stuff. Lizzie, thanks so much for that. Lizzie Burden, Bloomberg's UK economics reporter. Now, Russia looks set to resume gas supplies through its key pipeline to Europe, a relief for markets for the short term, because fears persist, of course, about more halts this winter. Let's bring in Anna Shuryevskaya right now, a European natural gas reporter. So, Anna, it looks like we've had a big drop in gas prices over the last week, I think 25-30% at least. What are the remaining risks that are keeping the market on edge?
Obviously, the risks remain, and they're bound, even if Nord Stream restarts after 3-day maintenance and early Saturday. Still, only one turbine is operating on the pipeline out of 8. So that means that, and Gazprom has said that that turbine will still have to be checked and maintained every 1,000 hours. That's 42 days. So potentially, if the other turbines are not put back in service before that. We're looking for another hold of pipeline in mid of October. That's when heating demand rises, and obviously implications would be much higher. And it just remains to be seen how long that shutdown would last, and if Gazprom could find some technical faults in the pipeline. So obviously that would keep us on edge for the entirety of the upcoming winter.
Bloomberg's Anna Sharifskaya, we thank you as always. Let's get a quick check on what's moving in the pre-market here stateside when it comes to those individual movers. I want to start with Moderna here. We know that boosters are now on the market. Omicron targeting boosters from, like you said, Moderna, Pfizer. Well, they're now ready for American use, and that is perhaps giving the shares a little bit of a boost here when it comes to Moderna, up about 0.2%. But once again, the entire market is rebounding just a little bit, not with a ton of conviction, but perhaps Moderna coming in on that trade. We should also take a look at some of the oil names. Exxon, for example, is back in the news. Shell and Exxon, I should add, selling their California oil venture to German asset manager IKAV. This is crucial when it comes to just kind of offloading some of their stakes. Shell, for example, getting $2 billion of cash out of the deal, and it's giving Exxon a little of a boost this morning as well, up 1.7%. Important to see that it's outperforming the pre-market action in futures. And Bed Bath & Beyond, our favorite retail stock that we like to look at, well, it's coming down once again, down about 2.5%. This is pretty normal as we start to see that build up in the meme stocks that's kind of having a little bit of a hangover. Now, a hangover, by the way, that has not really stopped as you start to really have a lot of questions about what this turnaround plan could actually yield, Tom.
Okay, this is our new favourite indicator, isn't it? Thank you very much, Kritty, on some of the corporates to watch. Coming up on the jobs numbers, Steve Blitz, TS Lombard Chief US Economist, will get his views on what it means as we look ahead to those wage prices and, of course, the overall number, the implications for the Fed. And Lensley Vinjamuri from Chatham House, head of US and the Americas program, get her analysis on that speech by Joe Biden and how it positions the Democrats ahead of those November midterms. Plus, we will get the Biden administration's take on the US jobs report with Labour Secretary Marty Walsh. That is at 9:45 a.m. New York time. Stay with us. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both radio and television. I'm Matt Miller here in New York. Kritty Gupta, Tom McKenzie with us out of London. Now, for now, at least, markets are still betting on a 75 basis point hike from the Fed in September. But of course, we get the all-important jobs number out at 8:30 a.m. New York time this morning. Noor Al-Ali joins us right now, Bloomberg Markets Live editor, to tell us if that makes any difference. Noor, is it going to change anything?
I think it'll absolutely make the difference and tip the odds further into the 75 basis point camp. I mean, I'm in the camp that supports higher rates for longer from the Fed. We've seen that kind of sentiment carry through from Jackson Hole. And if you look at indicators that the Fed look at, particularly their preferred inflation gauge, the core PCE. So those are the drivers of inflation. You'll see that it's quite elevated. So there's a lot of incentive for the Fed to raise rates higher for a lot longer.
Noor, what are the option markets telling us about volatility, expected volatility within equities?
Well, fantastic question. I wrote a post about this yesterday, and they are paying higher premiums for more volatility in U.S. stocks because that's basically seeking protections against that aggressive monetary policy. It's been a theme that we've seen so far this year where, since COVID, they were protecting against the pandemic and those risks associated. But now increasingly we see, options premiums going higher back to those pandemic highs because, investors are anticipating a lot more volatility as we walk into that Fed tightening cycle.
Yeah, as you said within that post, which is worth checking out on the M Live, risk within risk. Thank you, Noor Al-Ali. Great thing. Breaking down, of course, what's happening as we look ahead to that jobs number out of the US, what it means for the Fed, 75 basis points, and the options markets around volatility within equities. For more market analysis, do check out M Live Go on your terminal. Stay with us. This is Bloomberg.
Now, keeping you up to date with news from around the world, here's the first word. NASA will try again Saturday to launch its Artemis 1 moon rocket. The space agency tried earlier this week, but the launch was scrubbed because of a problem with one of the rocket's engines and other technical issues. It's the first major flight in NASA's ambitious plan to return to the moon, to return astronauts boots on the moon. This mission is carrying test dummies, though, instead of real people. COVID booster shots that target the most common new variants should become available in the U.S. within days. That's after the CDC signed off on the rollout of the updated vaccines. Moderna makes one of the shots, and the other one comes from Pfizer and BioNTech. Laxman Narasimhan, Starbucks has named Reckitt Benckiser's chief executive, Narasimhan, to be its next CEO. He is a veteran of the consumer industry. He'll join Starbucks next month, while longtime leader Howard Schultz stays in charge. Narasimhan fully takes over next April, but Schultz is still going to stay on the board. Among Starbucks issues, struggling sales in China and a push to unionize workers. And Tom, I just was thinking it will be difficult for him with, the boss around all the time. I wonder if Schultz at some point steps back.
Yeah, I think that personal dynamic is going to be really fascinating to watch, isn't it? Schultz took over again in April. He's pushed through a lot of big changes, so we'll see how that dynamic plays out. Coming up on the numbers, of course, Steve Blitz, TS Lombard Chief US Economist. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Jobs Day in the US. Today's numbers could determine whether the Fed decides to go for another jumbo-sized interest rate hike this month. President Biden banks on Democrats' outrage. He blasts Donald Trump and his supporters in a speech aimed at rallying voters ahead of November's congressional elections. And Europe's natural gas market gets some relief. Prices fall as Russia prepares to resume gas supplies through its key pipeline. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Matt Miller and Kriti Gupta in New York. Anna Edwards and Kailey Leinz are off today. Matt, the US job numbers, 298,000. That is the estimate.
That's the estimate, and, we're waiting for that number to come out before we do anything. I mean, it looks like there's a whole lot of nothing going on in markets, but don't turn off the TV because the levels are very interesting, and these markets could move bigly after that job number comes out, right? The S&P futures are doing nothing, but Savita Subramanian came out and reiterated her target of 3,600 to the downside. Meanwhile, you've got a lot of the other big-name strategists like Binky Chadha and Tom Lee and Klonovich all saying, 4,600 or 4,500. So there's a real divergence in opinion, and it all hinges on the Fed, which is watching this number very closely. We have the 10-year yield right now also not doing much, but at 325. And now we've seen the global ag, this big index of government and corporate debt, falling 20% into a real bear market from the highs at the end of 2021. So that's a really big story as well on the bond side. The dollar index, right now the Bloomberg dollar index, which I think is a much better index than the DXY. That's the old school Wall Street. This is the new way of looking at the dollar. It's at an all-time high, hovering right around there, over 1,300. And that makes a huge difference to the Fed. It makes a huge difference to the economy. And it makes a huge difference, especially to countries outside of the U.S. Bitcoin, okay, we still leave it up there because crypto is still kind of a hot fad, but it's at 20,000, and it's going to track other assets as it does. But I just think, Tom, it's so fascinating to see all these levels, and if the job number misses, maybe that pushes the Fed to reconsider how hardcore its stance is. If it beats, maybe we get a 75 basis point hike in September. Kriti?
Yeah, Matt, I am looking at some of the pre-market movers this morning. You are starting to see some movement in some really an old story here. COVID coming back to the forefront. Omicron targeting boosters from Moderna and Pfizer they're now ready for the U.S. use. So you can actually go to your pharmacy. You can actually go grab them. And that is perhaps giving a little bit of a lift to shares of Moderna, up about 0.2%. We'll talk about Shell and Exxon as well. They're both selling their California oil venture, their stakes in it, to German asset manager IKAV. Shell specifically about to make $2 billion in cash off of that transaction. For Exxon, it means a lift in their shares up about 1.5%. And of course, a retail favorite, the one spot where you don't see green on the screen, Bed Bath & Beyond shares down just shy of 4%, Tom.
Okay, gritty across European equities. You're seeing gains of 0.6%, a little bit of catch-up given the gains that we saw, the closing out in the green of Wall Street, but also the gas factor. And you have seen now Russian gas data suggesting around the pipeline that those gas flows are going to come back on Saturday. And you've seen, as a result of that, pressure on prices down around 13%. The context is, across this week, you've seen a drop of about 30% in terms of gas prices. Still very, very high levels historically, but a little bit of temporary relief, at least at the margins, when it comes to the energy story here in Europe. And that has given a bit of a boost to the equities market. Autos gaining, particularly on the back of that, given the industry in Germany and the reliance on gas. Euro-dollar is also part of the mix there when it comes to that gas story. Gaining 0.4%. Part of that, of course, softer dollar, but also playing into that is what's happening around the gas price. And Shell, this is one corporate story we just want to pull out for you. Reuters reporting that the CEO, Ben van Beurden, will be stepping down in 2023. He actually cut dividends for the first time last year, for the first time since World War II. And he's also been pretty consequential in reworking that business as they move more towards renewables. Gains of 1.5%. They have two candidates within, internal candidates within the business. It seems like, to take over from Ben van Beurden. Matt.
All right. We have with us right now one of the economists from whom I've learned the most in my career throughout Bloomberg. Steve Blitz is here. He is the chief US economist at TS Lombard. We've been talking for a couple of decades now, Steve, so I'm really excited to have you in the studio. I want to ask about, I think, one of the most interesting dynamics that we're looking at today, and that is the non-accelerating inflation rate of unemployment, nehru, which we haven't really talked about that much since the great financial crisis. But now it looks like we way undershot that, and the Fed wants to squeeze unemployment a little bit higher. How do you think that dynamic is going to play out?
Politically or economically?
Well, that's exactly my question, right? Because if they start putting Americans out of work on purpose, Elizabeth Warren's already questioning it, and more people are going to be angry about it.
Yeah, exactly. And as much as people don't like paying high gasoline prices, I mean, this is more politics than it is economics. If you go back to when Reagan got elected, there was a clear vote in the United States to end inflation. So it wasn't questionable. And so people were, at least politically, they weren't happy about 10% unemployment, but there was a political will in that direction and to do the things that were necessary in order to accomplish that. I'm not so sure that you have that same will today. And I think what is more likely ends up is that the Fed's going to look at this 2% target and say, what was so special about 2% anyway? That maybe 3% is the right number. So along the way towards a higher unemployment rate, and we're going to get a higher unemployment rate, and the Fed is going to create a recession.
But at what point does the unemployment rate start to really freak people out, make people angry, put pressure on Jay Powell?
My guess, it's a pure guess. My guess is around 4.5%. Once that, we're like a big, just like here, you're big-handled people, right?
Yep.
It's like when the equity market goes from a 4 to a 3, all of a sudden, or in the other direction, it's a lot of news. So I think once you get over 4%, right, because you're at 3.5 now, people are really going to start to take notice. So the issue at the heart of the labor market is that it's disjointed, right? You have these massive job openings and you have a very tight labor market. What is the time frame to put things back into the normal? What kind of time frame are we looking at?
You're never going back to normal. Okay. I mean that's the truth. And look, I said this 2 years ago. Whenever you have a recession, the ensuing expansion is always different than the other one. Right? I go look at the 60s, 70s, pick your decade. They're all different. And the mistake everyone makes is to assume that the prior expansion, or what it looked like, reasserts itself. So think about it. Because of COVID, you've got a lot of people over 65, over 60 who've left the workforce, right? They're not coming back, right? I don't think that Bloomberg is having a job fair hiring 70-year-olds, right? So they're not coming back into the workforce. The Gen Z generation, which is just now at the front edge of coming into the workforce, is smaller than millennials. And then you have all the H-1B visa things and stuff like that. Again, you can talk to Bloomberg HR department about getting people from overseas into the U.S. And under Trump, that got broken or changed or disjointed or whatever adjective, but it's different, right? And so you have a permanent shift in the supply of labor. Right, and at the same time, with reshoring, you have an increase in the demand for more skills, because that's where the job growth is going to, as opposed to, leisure and hospitality.
Steve, there was a really interesting comment, I thought, from Mike Wilson of Morgan Stanley yesterday, saying that he's concerned that maybe you get corporates hoarding labour, given the challenges they face post-pandemic to get workers back in to offices and factories, and that could pressure margins at the corporate level. Are you seeing any evidence of that?
Not yet, and I know that's a really strong narrative that in this recession, and that you're not going to get the same level of increase of unemployment that you have in prior ones because of this hoarding aspect. When firms have a hard time and earnings are poor, they're going to dump people. That's just what they do.
Well, and we're already seeing that, right?
Yes.
Like, for example, Snap apparently boosted its headcount by 50% last year. Well, no wonder they're cutting 20% of their jobs now. Right?
Exactly.
And it's not just tech. We're seeing yesterday we had 3M, one of the oldest industrials in the Dow, cutting jobs.
Right. And so firms will absolutely lay people off again. Now, because you don't have the same level of misallocations and problems that you have in coming into normal recessions, I don't expect 8-10% unemployment, right? I'm thinking more like 5.5-6%. If you want to say whether that's that's an okay increase or not, that all depends whether or not you've kept your job or lost your job.
Well, if 4 wasn't full employment to Jay Powell, then 5 or 6% is terrifying, right?
Right, exactly. And so I think that you do get to 5.5-6%. My own work showed me that 5.5% is probably the quote unquote nehru, but nehru can change too. I mean, it's one of those numbers you really only truly know in retrospect. But I think 5.5-6% is probably where you end up going, and it's going to be disruptive. Look, it has been since the 70s, really, that you had a period where the inflation rate was so high above the unemployment rate, right? Not normally, but since Volcker, it's been the other way around. Right. The unemployment rate has tended to be higher than inflation, and you're not going to get that correction in some sort of fairy tale way, while the rest of the world is slowing, goods price. The point is that over the last 3 months, on an annualized rate, according to the Atlanta Fed, nominal wage growth is 7%, 8.5% for job switchers, right? And now you have full employment, and now gasoline prices are coming down, so it's no surprise that consumer sentiment is going up. So now you're getting into a point where you're going to ratchet up growth in going forward here. And I think the Fed understands that, which is why I think just as they look through the CPI number that we got in July, they're going to look through this August employment number. They're going to understand it's a little bit lagging. And also, the general rule of thumb, if you go back pre-COVID, was that 125,000 job gains per month was neutral in the sense that, the flows coming in and out that kept the unemployment rate where it is. So 175, 150, 200, just keying off of the ADP numbers, which who knows if they're right. We'll find that out in a few hours. But that's that's still a high number.
Solid.
Yeah.
Yeah, Steve, fascinating as well to read the Bloomberg economics analysis and their call that they've broken down the numbers. 100,000 is all you need on average over the next few months to keep that unemployment level at around 3.5%. So there's a long way to go, as you say. Steve Blitz there, fantastic insights. Thank you, of TS Lombard. Coming up, Leslie Vinjamuri, Chatham House, head of US and the Americas program, get her views on that speech by Joe Biden, the threats to US democracy and where it leaves the Democrats and the Republicans leading up to November. Stay with us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking at a live shot of the principal room. Coming up later today, an interview with Apollo Management Chief Economist Torsten Slok. That coming up at 1:30 p.m. New York, 6:30 p.m. London. This is Bloomberg.
While the threat to American democracy is real, I want to say as clearly as we can, we are not powerless in the face of these threats. We are not bystanders in this ongoing attack on democracy.
That was President Joe Biden in his primetime TV address. Leslie Vinjamuri, Chatham House head of U.S. and the Americas program, joins us now to talk about this. I don't know if about face is the right word, but it really is a change, Leslie. As the president came into office, he completely avoided using Trump's name even, and the progressive wing of the party was pushing for him to be more aggressive, but he wanted to be the president for everyone. I think he said that very recently. Now he's made it clear that is no longer the case.
That's exactly right. We saw in that speech a president driven to send a very clear message to Americans about the challenge to democracy, and that's backed up by the polling. We've seen recent polling suggesting that a strong majority of Americans see the threat to democracy as their number one concern. He's building on that momentum. He's also clearly trying to peel off mainstream, as he calls them, mainstream Republicans, as also being very committed to securing and preserving and rescuing America's democracy. But he really calls out Donald Trump by name, as you said, a real shift for this president, and the MAGA Republicans. He says this again and again, and that was a very powerful message. It's a big bet. This is a president who is more popular now than he was in July, who has had some recent successes. Polls, the Wall Street Journal polls have demonstrated that the Democrats are doing significantly better. If you ask people how they feel about Republicans and Democrats in their local constituents, it used to be that they felt better about Republicans several months ago. Now Democrats have a slight lead. You know, polling is always something that we have to take with some skepticism, but there's a bit of a bump for the Democrats. And I think most significantly, Donald Trump is back. He will be in Pennsylvania. It's very clear that that message will be loud. It will get a lot of attention. And the president, the White House, his team have decided to be very front-footed as we lead up to these midterm elections. The other thing to note, the White House Twitter account retweeted a New York Times article naming the 147 congressional Republicans that voted to challenge the result of the 2020 election. I mean, this is quite a concerted effort, and it's very front-footed.
Is that a strategy that's going to work, though, Leslie? Are we going to see some backlash from the GOP?
This is the big question. You know, it's not possible to know because there are multiple factors here, right? There are, you know, I would say three. One is that voter turnout, we think, will be driven by the reversal of Roe versus Wade, abortion rights, on the Democrat, but also on a number of moderate Republicans, women in particular. Voter turnout on the Republican side might well be driven by the feeling that the FBI investigations of Mar-a-Lago were politicized, not appropriate or fair. And then there's this speech and this concerted effort that we're going to see, which I think is, you know, exactly right. The threat to America is clear. The threat to democracy in America is very clear. There are concrete things to point to. But there will be not only many MAGA Republicans, many of whom won't be prone to violence, who will see themselves as patriots, as Americans, as will be pushed, I think, further away by the speech. But the real question is what happens to those mainstream Republicans, the same Republicans that I think Liz Cheney is hoping to court with the January 6 investigations. Will they be persuaded, you know, if not only in the midterms, but which is, you know, the immediate question, but going forward to peel off some of their support for the Trump wing of that party? It's a very tough call. It's a very big bet, but there's a lot of momentum and there's a huge amount at stake.
Leslie, you mentioned the FBI investigation and the raid of Mar-a-Lago. Which side benefits most from that?
Well, we have to hope that, you know, America benefits most because, remember, national security, we don't know exactly what's in those documents. We're going to continue to learn more. We don't know where they went. We know very little, actually, still. But in terms of, you know, the politics of it, it threatens to divide. And a lot, this is a dynamic, moving factor. How it's covered, what facts turn up, how widely they're shared. Will absolutely shape how people feel about that investigation. Right now, I think it's quite divided. If we believe the polling, Republicans see it as political, as not just, not legitimate, not legally justified. Majority, according to some polls.
By the way, Leslie, everything is divided like that, right? I mean, I don't know why we keep citing approval ratings for presidents, because you can only do as well as 50%.
Sure. The country is polarized, the country is divided, but there are multiple things going on. And, again, the one thing that we've seen is that just shy of 70% of Americans think that their number one concern is the threat to democracy in America. Democracy is not inherently a divisive factor when what people think is fair, whether they think specific elections were conducted fairly. There's a lot of division along those lines. And America, as we know, is not only divided and polarized and facing a very sharp, very radicalized segment of a Republican Party that has a lot of influence right now. But that division grew dramatically in the 4 years that Donald Trump was president. The question is, what happens when we get to these midterm elections? And for a President Biden, who has had some recent success, it's been a very tough presidency. If those midterm elections don't go the way that he wants them to, and usually they don't for a sitting president, then the next 2 years are going to be extremely difficult. But this is difficult in a context which is not normal. And I think this is something that the president tried to say again and again and again. This is not normal politics.
Yeah.
There's something very significant at stake here.
Hard to argue it's not normal when the former president continues the lie that the election was stolen, and many of his acolytes, of course, as well. Leslie Vinjamuri, thank you, of Chatham House, on this risky strategy by the current President Joe Biden to take aim at Trump and the MAGA Republicans, as he calls them. Thank you. Coming up on Balance of Power, we will speak with Governor Glenn Youngkin, Republican from Virginia. We'll get his thoughts. Stats at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg. Welcome back. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, Matt Miller and Kriti Gupta in New York.
Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. Tom, walk us through your single best chart.
What we've got today, Kriti, is a Labor Day Jobs Day chart. This is a chart from years ago. This made a huge splash pushing 20 years ago when I first put it together. It's not original to me. But as the manufacturing spirit of America is compared to total population, this is hugely political chart, with Pearl Harbor over on the left side, the booming World War II manufacturing economy, and then the slow rollover and the stunning log descent that we saw in the last 20 years out to what I'm going to call the Obama leveling out, the pandemic, and we've sort of kind of like made it back. But it does show on this Labor Day weekend the decline of manufacturing in America. We can argue all day about the politics of it.
Well, what's interesting, Tom, I was on the elliptical yesterday at the gym watching you and John Farrow break down the Minnesota Mining and Manufacturing Company release. So we've seen job cuts out of, Snap and Coinbase, but now it's hitting real companies.
Yeah, this is a really good point, Matt. We'll talk to Randy Krosner about this, former governor of the Federal Reserve System. But, Matt, you're dead on about this is transferring from what some would say is zombie companies over to the real American economy. We'll do that on this Jobs Day. Michael Purvis scheduled.
Never nervous.
Tom Keene, thank you. That is it for Early Edition. Markets here in Europe up 0.5%, range bound with your US futures. This is Bloomberg.